me know when you want to move on.
Yeah, well, let's not keep people waiting. I'm sure Tom and Henrik will join shortly. So thank you very much for the offer to speak today. It's always good to get our message out and start talking about that. There'll be 3 presenters today. Myself, I'm a partner at Downing, head of the asset management division, and look after a lot of the financial reporting across this fund. Tom Williams, who's a partner and head of energy infrastructure at Downing, and Henrik, who heads up our Nordic desk and works on a lot of those investments. The next few slides are a few important notices. So if you are able to look through these later, that would be very much appreciated. And we'll also perhaps we'll skip over this slide and move straight to the next slide. Actually, there's quite a lot of detail there as a summary, but I think that will be brought out as we move through this this slide pack. So at the core of DOOR is a strategy of diversification, and that diversification runs across a number of areas and really supports drive a stable and strong product. And we think a lot of the numbers and performance today, and we'll talk you through how that's come through, really do start to show how this strategy is coming through and creating value for our investors. So to give you a brief background of DOOR, we IPO'd almost a year ago, 10th of December last year. We are today still reporting on the June numbers. Actually, those are the most recent numbers we presented in the interims. But as of that point and today, we were 83% investors. We deployed those investment proceeds very quickly and into really good assets that performed well and consistently outperformed our expectations throughout the year. That has led to NAV growth. We'll come on to that later on in terms of how our approach to power price exposure, our approach to different Nordics, and our approach to the operations of these assets, and fundamentally how these assets are slightly different from what you may see elsewhere, come through. And all that has led to an announcement that we made a few months ago now in terms of bringing forward our dividend forecast. So originally we were hoping to pay 3 pence per share to our investors who joined us at IPO. Due to the assets performance and the speed of deployment, we actually managed to bring that forward. 5 pence a year will be paid from the 1st of July, and we're really happy to be able to do that. Just as a background to Downing as a investment manager, so we manage about 1.4 billion under management. We have a broad range of mandates and have managers across a number of funds and strategies. The energy team, one of the investment teams, one of the 4 investment teams at Downing, have 32 investment professionals. Over 15 years as the energy team has been functioning, and we've produced a really strong track record during that time. So we've made over 130 investments and achieved a slightly over 9% IRR on those investments on a weighted average. The investments we hold to date are also running at a very similar number. So a really strong track record of investing, managing, and then exiting core renewable investments. Downing's a firm, 180 people. The investment teams are heavily supported by a really strong back and middle office, and we can use the Downing platform to be able to grow and enjoy each other's experience and expertise as we go through that. There's some marks there on the right side in terms of awards and some of our commitment to ESG. The next slide actually goes into our commitment on from an ESG perspective in a bit more detail. As I said earlier, we manage a wide range of mandates at Downing. That goes from venture capital to quoted strategies through to property. Renewable energy is one of those mandates, and a very large focus for us. Central to our work, and has been for a long time, is our commitment to be a responsible investor. And we have a responsible investment policy that sets out the principles of integration, active ownership and transparency all the way through that investment cycle across the 4 mandates and 4 investment teams that we run. Sustainable infrastructure plays a vital role in reaching our desire for global emission targets, and within that, renewable energy obviously does play a very important role, and that's where this particular fund strategy focuses and looks to support that movement to net zero. On the next slide, I think actually this sets us apart quite a lot in terms of what, or bringing that point forward. DOR is an Article 9 company under the SFDR regulations. We're very happy to make the conscious decision on a voluntary basis to be subject to the Article 9 regulations. That means we have an investment policy and a core sustainable investment objective that is considered across all our mandates and investments and the way we act on a day-to-day basis to accelerate that transition to net zero. And we do that through making sure that our investment process and our operational management style means that we are really making the most of the investments that we make, making sure that they are doing as much as we can to reach that target. Our investment process starts very early through the screening regime. We will do lots of studies and have a proprietary ESG tool and management tool that will drive our focus and our work through that due diligence process. And that means that once we go through investment committee stages, once we move into an operational stage, from day one, we understand the risks, but also the opportunities at every asset that we have, and how they can help support our investment objective. I'm actually probably going to pass over to Tom now, who will take you through a bit of the strategy from a higher perspective, and I'll come back later to look at the performance.
Thanks, Tom. So yeah, having covered some of the aspects of the way we think about sustainability, and in particular around that Article 9, which we think is a real differentiator for investors. We really think that is something for you to bear in mind when you look at a range of those different funds in the market today. You know, it's a very confusing world. There are lots of standards, lots of people saying lots of things, and what we're saying is that this particular set of regulations that we look at, the SFDR regulations, and particularly that Article 9 designation of the fund, and having that core sustainable objective is something that is something that will increasingly be reported on. It will be very transparent for you, and it will be something that you will be able to really look at and when you're making your investment decision. So on to strategy. What we want to say here is just that at the absolute core of what we do is diversification, and diversification has 2 main benefits. The first benefit is that it broadens the pipeline of opportunities, and we'll share that pipeline of opportunities with you a little bit later on in the presentation. It is a very considerable one. The second is it increases the stability of returns. So if we think about diversification, we think about it in a number of different ways, and we've set those out for you here on the slide. We think about diversification by technology. So each different renewable energy technology is dependent on a different given natural resource. Those natural resources are variable, they are intermittent. And so it's a good idea not to be too reliant on any one given natural resource and any one given technology. If you move geography, you can access different natural resources and therefore different technologies, and increase that diversification, spread your risk. You can also, if you invest in different geographies, access different markets. So these assets sell electricity for revenue. When you sell that electricity into a different market with different fundamental drivers, as is the case between the UK and the Nordic region, then you can achieve different outturn pricing that also changes the nature of your risk. It spreads that risk. You can also, where you invest in different countries, diversify your regulatory and policy risks. When you combine diversification by technology and geography and project stage, you get a diversified set of revenues. That's very important. That's what drives that stability of return. And we also here have some observations about the reducing that merchant power price exposure. We'll talk a little bit about that later on. So just to give you a little bit of an update on where we are on the process of investing the fund. So we invested a touch over 80% of the proceeds of the IPO. In fact, we'd actually invested that after about 4 months. The portfolio is now 8 operational hydropower plants in Sweden, which we hope we'll be adding to soon. We've got a number of those opportunities in the pipeline, and a large portfolio of operational solar in the UK. If we look at the hydro, as I said, 8 hydropower plants on 3 different river systems in 2 different price regions in Sweden. You'll all recall that Sweden has 4 price regions. They are separated like this because there are constraints in moving electricity between the different regions in Sweden. Therefore, there are different prices. So it's quite also important to try and spread your investments across those price regions. So we believe anyway. They've been operating for a long time, these hydro assets. So in some cases for about 80 years. So there is a considerable track record. And there is no reason that we believe why these hydropower plants should not be operating in another 80 years. And the reason we believe that is because they own the land they're situated on. They have perpetual rights to the water that flows past them and through the turbines. And the assets themselves are very simple to operate, and they are very robust. The portfolio itself is now of a scale where we're looking at attractive bolt-on acquisitions. So these are smaller individual or groups of sites that we're thinking about bringing into the portfolio, and those would be accretive to the overall returns of the fund. Now, touching on hydropower, people think a lot about hydropower as really big dams and flooding huge areas of the land, and that being bad, which it is for the environment. So what we wanted just to tell you about here is some initiatives specifically within Sweden. First of all, the hydropower plants that we invest in are run of river. They do have some reservoirs, but those have been there for a very, very long time. And those just fit into the river system. So they're typically sort of small lakes or things like that. There's about 20 of them along the different river systems that the portfolio is situated on. Now, in Sweden at the moment, and one of the reasons why we chose to invest in hydropower in Sweden is that Sweden introduced in 2019 some regulations which were aimed at bringing the status of the existing hydropower plants up to modern environmental standards, because a lot of those facilities like these ones have been around for a very long time. It's called the National Plan. It was essentially the Hydropower Environmental Fund, which was a large, about 10 billion SEK, which is about £1 billion, was put together in order to fund the costs associated with the program. And then people had to apply to register to be in the National Plan, and then your facility is then assessed over a number of years. It actually goes all the way out to about 2035 by the time you get to the later ones in the plan. And typically what happens there is they're looking at ways in which to reduce the ecological impact of these hydropower plants on in the river systems that they're situated in. So a typical kind of a measure that they might want to have us include is something like the picture on the right here, which is the picture of a fish ladder, which is a pretty funny name for a simple series of steps and pools and the fish who are trying to go upriver, which they would otherwise find that difficult to go through the slipways that are to the sides of the hydropower facilities, can hop up all the way up the river and continue their natural migration up and down the river system. So that's the kind of thing that we'll be bringing in across all of our assets. We'll be looking across the whole portfolio as part of this plan, and that's very much been built into the investment case that we formulated when going into the assets in the first place. So slightly less exciting on the environmental front, the UK solar assets. So these are about nearly 50 companies. They own existing operational UK solar assets, typically ground mounted, but with some rooftop assets as well, situated all around the UK and Northern Ireland. They've been operating for sort of 6, almost 7 years now, and they've got very high degrees of fixed revenues. What do I mean by that? I mean that you're receiving a fixed price per unit of energy for across the portfolio. So not only do we have subsidies, because these are assets that were built in the time where there were government subsidies available for solar in the UK, but also they've got long-term sales agreements with floor pricing, so minimum price that you achieve for the energy that you're selling. So about 86% of the portfolio benefits from that. So just moving on. What does that mean then in terms of the portfolio? So we have it here. We've got that hydro and solar there with a bit of cash. We have in the middle, split by geography or power market. So we sell into 3 main markets: the Swedish market, the UK market, and the single electricity market, the Irish market. And then on the right hand side there, just to say that at the moment we don't have any construction exposure, although we do hope to introduce some of that into the portfolio in due course. I won't spend too long on this slide, but it's just to try and give you an indication about how we manage merchant power price exposure. We do think that is a very significant risk in these kinds of funds. So calendar year 2021, we're almost through that now, but this has remained pretty constant at quite a small portion of merchant power price exposure, which is that little sort of piece in the top left hand corner in grey. And on the right hand side, we've got a year 10 years in advance. So as we stand today, we can see that more than half of the revenues are fixed, and a little under half are variable. And as that year in 2030 comes closer and closer to us in time towards 2021, we will fix more and more of it, particularly when it gets into about sort of 5 years out. We can start fixing in the Nordic region, 3 years out in the UK, until eventually the strategy is to get to the year that we're in, or the year that is shortly about to follow, and that will start to look more like that 2021 number. Okay, so with that, I'll hand back over to Tom. He'll just take you through a couple of our key performance metrics, and of course that starts with sustainability.
Thanks, Tom. Yeah, so we spoke earlier about our strategy and our driving factors behind our approach to our sustainability targets. This slide, it comes from more of a practical perspective. Downing have spent a huge amount of time, millions of pounds, building up a in-house asset management team. That team looks after these assets on a day-to-day basis. It includes accountants, engineers, commercial, data analysts, and legal support. That structure, that provision of services means that we get really close to the assets on a day-to-day basis, really understand what drives them and how we can make them outperform, both from a generation financial perspective, but also from a sustainability and our impact on the environment. We really do see a great amount of responsibility in the land and the waterways we manage, and there's a lot of processes and activity on the ground that focuses on improving the impact that we're having on a day-to-day basis. So at any one time, we will be working on our relationships with local landlords, local residents, local educational groups and charities, enhancing biodiversity across the sites, and we're able to track and monitor all these KPIs through our data team. The data team manage and review about 3 million data points a year, and that's a vast amount of information, which enables us to draw out quite detailed analysis on how we're performing and help set our targets for the next year. Moving on to the financial performance. So a lot of the strategy that Tom mentioned earlier came through in the financial data to the interims, which were for the period 6 months to June, published a few months ago now, but still the latest information we've published. You can see here the driver between that shows the main drivers of the NAV increase. So starting at an effective NAV of 98p at IPO, that increased to a little over £1 during that 6-month process. And the two main drivers you can see there, the green columns, are the performance of the assets. So ultimately we generated more than we expected to generate, and we sold power for more than we expected to sell the power, really supporting those cash flows supporting the dividend announcement to bring that forward that we touched on earlier. Also saw an increase in our future power price forecasts across both territories, which supported that NAV growth. On the next two slides, we split out that growth per the underlying investment. So this being the hydro investment, it's a similar story across both assets. You see there the outperformance from a financial sense, the fact that we have dam and storage facilities that essentially act as a giant battery means that we can really make the most of the higher spot prices that we see in the market, and make sure that we are maximising our revenue given the generation we have, and the power curve there in terms of an increase in our expectations of future power prices. The solar side, the next one's very similar. Again, outperformance, generated more than we expected, and through good cost control and maximising profits there, we were able to increase, or that valuation increased over time. We also, as part of the interims, disclosed some more information around those valuations. So we disclosed information around the assumptions we're making to our asset life. On the solar side, we're assuming 25 years on that ground mount portfolio. There are others in the peer group that assume more value for a longer life, and there's a project underway at Downing to make sure that value comes through to investors in time. We disclose our discount rates for the first time, published a range of 5.5% to 7.5% across our portfolio. Both ends of that range, in fact, relating to the solar assets on a levered and an unlevered basis, and I think that's also places quite well in terms of where we expect to be over the next year or so. So really happy with the financial performance that we published to date, and really do think it's the strategy that we've set out is starting to bring that value through. I'll pass it over to Henrik to go through some of the pipeline opportunities we're seeing.
Yep, thanks, Tom. So at the moment, we do see a very significant deal flow, both here in the UK, but also in the Nordic region. And I think what's really encouraging is that this pipeline is spread across all the different technologies that the fund has a mandate to invest in. As you can see on this slide, we have several £billion worth of deals that we can progress. That's sort of academical to a certain extent, as what we will do is only look at a fraction of these deals, but it provides a broader context as to the deal environment that we operate in. What we do is we focus on acquisitions which we think are value enhancing to the portfolio and where we can see further diversification benefits. And if we bring it a bit more specifically, what are we currently looking at? Well, we got a few different hydro deals that we are reasonably well progressed with and hope we can successfully conclude over the coming months here. These investments, they will be done through the existing platform, through Downing Hydro AB. So we'll expand and diversify that asset base further. Having set this business up, we'll have certain economies of scale through the existing platform for the investments that we have. And that means, I suppose, that these transactions we are looking at, that they should be value enhancing to the existing platform that we have. The portfolio is also spread across the portfolios we're looking at are also spread across the different price zones in Sweden, and also different rivers to what we're currently exposed to, which provides some of that diversification benefits. In addition to hydro deals, we should also mention that we are looking and progressing a couple of different wind transactions, which I think we should be reasonably optimistic that we should be able to close out here. I think one of the benefits with this is for the fund that once concluding those transactions, we will have further resource diversification for the fund as well. So I think to wrap this up, there is a significant deal flow. We are being very active, and we are optimistic that we should conclude some of these deals in the not so distant future. I think with that, I'll wrap up on the pipeline and hand back to Tom Williams.
Thank you very much, all three of you. I'm glad you got that on the end, but yeah, sorry about the technical issues. So let's start with this slide then. So where are you getting your ideas from, and how long does it take to get something from this might be a good idea to we've now bought it?
Yes, so in terms of sourcing opportunities, we get those from a range of different sources. So the first is our own networks. We've got a large and very experienced team within Downing. They've been in the renewable energy investment or advisory business for a long time. So a lot of people come directly to us with opportunities. So we have exclusive and bilateral opportunities that are presented to the vehicle. We also have, because of that network of people that we know, we also are involved in a number of processes where people run an auction to sell their assets, and that's quite common. And we also have a number of opportunities that we're looking at with developers as well. So not just people who own an existing asset that they want to sell, but also people who want to be funded to build new assets. And there are a number of construction opportunities that are presented to us as well. So it's a whole range of different people. We're also sourcing some sort of slightly unusual places. So we have one deal where, for instance, some of the banks that have been involved in funding a project have come to us and asked us if we would like to take over the management of the project, for instance, because they feel that the existing owners haven't quite looked after it as they should do. So there's a number of all sorts of different places and different opportunities. In terms of how long it takes us to from that first stage of an opportunity coming in to actually sort of executing an opportunity, it is quite a long time. So some opportunities it might be as long as 6 months. Others it could be as short as a couple of months. But it does take a while, and it takes a while because we conduct a great deal of due diligence on the opportunity. So typically we would conduct legal, technical, insurance, and commercial due diligence on an opportunity before we were to invest in it, and that does take a lot of time. It's a very painstaking process because these assets, although they are generally quite simple in terms of operations, they need a great deal. There's a great deal of paperwork that goes around them, and all of that paperwork needs to be absolutely on point, because that paperwork is what gives you the right to own and operate that business for the long term, and that's what we're investing for.
One of the things that differentiates you, and I think makes it quite an interesting fund, is the exposure to Sweden. So can you just talk a bit about the attractions of that market and power prices in that market relative, say, to Germany, which is not very far away from it? And also, beyond Sweden, are there other countries in that kind of region that you're likely to pop up in?
Yeah, so why don't I deal with the sort of where next, and then I'll hand over to Henrik and perhaps give you just a bit of background on the market outlook for Sweden and in fact the general Nordic region, and how those differ from the UK, which, if you remember, is one of those, so that sort of core thesis of diversification and selling energy into different markets and having those different markets driven by different things, right? So so first of all, let me talk to you about where next. So we think there's a long way to go in the Nordics. So we're seeing very attractive opportunities, particularly in the wind space, in Finland. So we particularly like Finland. We see there's still a long way to go in Sweden, particularly in the hydro space. That's the sector that's really working for us at the moment. And then we see other opportunities in Denmark, in Norway, and also perhaps in some slightly different sectors like geothermal in places like Iceland, where there's also quite a lot of hydro. So that feels to us like the next few places, and we're already got a number of opportunities that we're assessing in those jurisdictions. In terms of the different markets and the different energy markets, before I hand over to Henry, I just wanted to make one point, and that is, I talked about different fundamental drivers of different energy markets, and in the UK at the moment, you can very clearly see that is a gas-driven market. And why is that a gas-driven market, or to a certain extent carbon as well? It's because gas-fired power stations set the price of electricity in the UK, and when gas is high, power prices are high. What unfortunately is happening at the moment in the UK is not only a gas power price is high, but carbon prices are high as well, and so you've got like a double whammy. The good news about the portfolio that we have in the UK, which is a solar portfolio, is that they don't use gas and they don't emit carbon. And so what that means is that they are achieving higher prices for the sale of their electricity than we would necessarily have thought about in the start of the year. And they're not having to pay for their fuel or pay for the carbon, so the margin that you're making from that is greater. So those assets become more profitable in this kind of environment. In the Nordic region, that is a region which is not driven by gas, it's driven by hydrology. So how wet it's been, how much rainfall there has been, because the dominant form of electricity generation in the Nordics is hydro. So you have two different markets with two different fundamental drivers and two different outturn prices, and as a result, different prospects. And that's where I'll hand over to Henrik, and maybe he can talk to you a little bit about that.
Yeah, so I think that's a good introduction that Tom made here, and I think in the Nordic market there's a lot of opportunities, both within the hydro space and also in the wind space. And the Nordic market is dominated by renewable energy, and the other source of energy that exists is nuclear power, Sweden and Finland. The other theme that you then see with this is, especially in Sweden, that nuclear power plants have been decommissioned, and what that's then done is to provide even greater value on dispatchable energy sources, which effectively means hydropower. And that's a thesis that we would expect to continue to be maintained in the medium to long term, i.e. that dispatchable renewable energy hydro will become more and more valuable to meet the overall demands and the sources that are being generated by wind. That's an attractive part of the thesis here. The other attractive part of the thesis is that the Nordic market tends to export its energy or its surplus energy, which has been obviously doing for decades, but there are more and more cables, interconnected cables that are being built. So we have the North Sea Link cable from Norway to the UK that was completed and became operational now in, I think it was October this year. So that's another way of the region then for exporting its energy. There are other cables that are being built to the continent, to Holland, Germany and Poland. And what that of course does is look to drive up energy prices as more and more energy can be exported to the rest of Europe. So that's a good fundamental behind the sort of investment thesis into the Nordic market. On top of that as well, the Nordic market, like any other market, I suppose, is seeing a big electrification of its overall energy uses, which then in turn will come from the renewable energy sources. So it's an overall good scene to make investments. We like the long-term fundamentals behind this market. The other aspect which makes this market interesting is the type of deal sizes that we are looking at. I think in general you see less competition for those deals than what you perhaps would see in many other European jurisdictions. So that's positive for us in terms of how we operate, and brings part of this deal flow that we set out on the slide here. The other aspect is, and especially for the hydro side, is that we now have acquired an attractive platform of hydro assets, which is sizable, which means that to this platform we're able to actually make individual acquisitions of hydropower plants onto this power plant, which you wouldn't do if you didn't actually have a platform on its own now. So I think we're very optimistic about the geography. I think what we need to continue to be mindful of is to make sure we have the right exposure to the different price zones. So that the different price zones, both Norway, Sweden and Finland, they do behave slightly differently, and you do need to be mindful that you don't put all your eggs in one basket and spread that exposure across the geography. I think I'll stop there for now and let some other questions come through.
So Tom, then, there's a question about how do you tackle resource-related risk, such as reliance on wind speeds?
Yeah, so I think that's just continuing what Henrik just said. So if you want to spread your risk, what you do is you follow the kind of strategy that we're talking about. You invest in different technologies in different geographies. And that way, you are not overly reliant on a given natural resource in a given location. And even where you are investing in the same technology in different locations, that can still diversify your risk because the wind doesn't blow at the same time in Stockholm as it does in Surrey. So you can diversify both by geography and by technology, and that's how you address this issue, because long term, they will always revert to what you expect, your sort of balance of probability production. But in the short term, you see these variances, and if you want a consistent return, then our belief is you are best off achieving that by investing in a spread of different opportunities, technologies, and geographies.
Well, thank you. So there's no exposure to storage at the moment. So am I right in that? But you are planning to get some. Do you have the same sort of opportunities in terms of the revenue streams here for storage that you do in the UK, in the Nordic markets, for example?
Well, it's an interesting statement, right? So saying we don't have any exposure to storage, because I would actually argue that we have exposure to the longest duration storage that there is. In some of the reservoirs that are on the river systems that we have in the hydro portfolio, we can actually store energy and move it across years. So you know, you're not talking about a 1 hour battery or a 2 hour battery, or, you know, maybe we can get to a 4 hour battery. You know, we are talking about storage that lasts days, weeks, months, years. And so when you talk about price optimization and things like that, and trying to capture the value of the peaks in daily or power pricing, then I think you can really do that, and you can really concentrate your production into the times of the year where prices are more expensive, which is not a luxury that you can afford with a wind asset or a solar asset, right? Where, you know, the sun shines at better, you know, more in the summer than it does in the winter, unfortunately, and that's just how it is. And you can't build a battery big enough to move your production from the summer to the winter where prices are better. Yeah, so perhaps there's a subtlety there around the reservoirs, but you're absolutely right that we don't have any battery storage assets. We do have plans to do that. I think it is most likely that we would start with co-location. We have a large number of solar sites in the UK, for example, where there's a good case for putting batteries alongside the facilities, and then just changing when that power is exported to the grid, so shifting the load around, and then perhaps also some associated revenue streams with that around some of the ancillary services and trading activities that you might be able to make with the batteries. There is no doubt, though, that revenue stream is less contracted, more risky, and therefore higher returning, potentially, but with more risk associated to it. So we need to be quite careful about how we introduce that into what is quite a heavily contracted and quite stable portfolio.
Cool. Okay, thank you. One more question, I think, then we might have to wrap up, but just maybe talk about your dividend policy. The question is actually talking about how you ensure it's sustainable, and do you need revenue reserves to do that? But maybe you can explain how you go about it.
Yeah, I mean, delighted to. So where we are at the moment, as I think Tom mentioned, was we have we're in a situation where we invested the proceeds of the IPO faster than we thought we would. So we thought it'd take us about 12 months. It took us about 4 to get to be a vast majority invested. We've invested it into assets that have performed better than we've expected. And so therefore, as a result, what we've been able to do is we've been able to bring the dividend forecast forward by 6 months. So we thought we'd have 1 year at 3%, and then the second year we'd be able to deliver 5%. We have brought that dividend guidance forward so that as of 1 July this year, we're aiming for that 5%, not the 3%. Now, we would not have done that if we did not think that we could then sustain that going forward. And on our projections, we are able to cover that revised dividend with the assets that we have at the moment. So therefore, as we invest in more assets out of cash and into assets with the remaining proceeds of the IPO and also the proceeds of the recent raise, we will be able to increase the cover that we have for that dividend. That's number one. Number two is the type of assets that we are investing in. So in the long term, solar and wind assets have a finite life. So at the end of their lives, their terminal value is zero. And so what you're doing is you're not only delivering a yield from those assets in between now and when the terminal value is zero, but you're also effectively paying back some of the principal each time, so that when you get down to the end of its life, your balance is zero. Right? What you need to do in order to sustain your NAV and sustain your dividend is to reinvest that portion that represents the repayment of your original investment in those assets each year into new assets. That's exactly the same for us on the solar and wind side, but on the hydro side, those assets don't have a terminal value of zero. In fact, their terminal value is worth more than they are today. Right? So actually, in 30 years' time, all of our hydro portfolio will be worth more than it is today. So it grows in value over time. And so if you talk about protecting dividends and protecting NAV, these are great assets to invest in, because we don't have to reinvest. All we have to do is invest in maintaining these assets and keeping them working, maintain that appropriate capex to make sure that the life of the asset is what we hope it will be, which is a very, very long one. That's very much a feature of the hydro assets. We also look at some other assets like utilities, where you have exactly the same thing, exactly the same dynamic. And that is what makes us a little bit different as well from others.
Cool. Thank you very much for all that. I think we've explained how the fund works quite well. So it's good to good for you to have you round up our environmental day for us. Thank you. Thank you, all three of you.
Yeah, thanks very much for having us. It's been a real pleasure. Thank you.
Cool. So that's it for our environment.